Across America, millions of recreational vehicles are about to hit the market all at once. And when that happens, values don't just dip, they fall off a cliff. Dealers are drowning in unsold stock, lenders are pulling out, and repossessions are pumping more supply into auctions every week. The result? A price crash so steep it could erase years of equity overnight. If you own an RV, your window to act is closing fast. If you're looking to buy, the deals are coming, but how will you know when the crash has hit bottom? The 3 million surge. The used RV apocalypse is here. A staggering 3 million recreational vehicles are about to swamp the American market all at once, overwhelming dealers and private sellers alike. What felt like a golden age of camping and road tripping only a few years ago has flipped into something much darker. During the pandemic boom, families stretched their budgets to secure travel trailers, fifth wheels, and motorhomes. Manufacturers rushed to meet demand. Rental fleets clung to their stock, and dealers happily booked record profits. But the surge of new owners created a delayed tidal wave. Now those same families face rising insurance costs, higher storage fees, steep repair bills, and loan payments that no longer match the falling value of their rigs. Rental companies, finally able to restock, are dumping thousands of units. Leases written in 2020 and 2021 are expiring, sending more supply into circulation. The result is an unprecedented glut. But this flood is not starting on the dealer's lot. It begins at the bank. Banks, pull back! Financing desks have the power to turn paper losses into real ones, and that is exactly what is happening. Recreational vehicles are often purchased with decade-long loans, but lenders are tightening the spigot just as values fall. Dealers who rely on floor plan credit lines are now getting calls from bankers demanding fresh cash to cover shrinking collateral. For a dealer holding 100 unsold units, every appraisal cut multiplies into tens of thousands of dollars in exposure. The same banks that fueled the boom with easy money are retreating, leaving both buyers and sellers gasping. For ordinary families, the change feels sudden. Loan approvals that once came in days now get delayed or denied outright. Minimum credit scores inch higher, down payments climb, and interest rates add hundreds to a monthly bill. Buyers vanish, dealers sit on swelling stock, and the market buckles. And when stretched owners cannot refinance or sell, the repo truck is the next visitor in their driveway. The repo conveyor belt. Every tow truck is another crack in the dam. Repossessions, once a background hum of the industry, are becoming a roaring conveyor belt feeding vehicles into auctions. Behind every statistic sits a story. The Oklahoma oilfield worker who lost hours and then his motorhome. The Florida nurse who chose rent over her trailer payment. The young couple in Arizona who thought they were securing a lifestyle, but instead signed up for an anchor. Each unit taken back by the bank adds pressure to a resale market already drowning in inventory. Industry watchers count thousands of repossessions every week, and wholesale yards are filling up. At auctions, lenders slash reserves to move units quickly, driving comparable values down for everyone else. The cycle is merciless. More repos mean lower prices. Lower prices mean more owners underwater, and that means still more repos. Yet even a clean repossession is not the scariest threat waiting for unsuspecting buyers in this flood. If you're already seeing how fast this market is cracking, hit that subscribe button so more people can see the truth before it's too late. And drop a comment below. Tell us what RV values look like where you live. Your story might be the warning someone else needs. The zombie RV problem. Not every bargain is what it seems. Alongside repos and lease returns lurks a darker category of inventory: flood-damaged and tidal-washed recreational vehicles. In the past 2 years alone, storms and hurricanes submerged tens of thousands of units. Many were properly totaled, but a troubling number slipped back into circulation with suspiciously clean paperwork. Dealers desperate for inventory and buyers desperate for deals create the perfect environment for these so-called zombie RVs to spread. On the surface, they may look fine: new carpet, deodorizer, and a fresh coat of paint. But inside, hidden mold creeps through ductwork, electrical systems corrode, and brake lines weaken from the inside out. Within months, a dream purchase can turn into a nightmare of repairs and safety hazards. As the flood of inventory accelerates, more of these compromised vehicles will slip through the cracks, and the people most exposed to these risks, they are the very dealers standing between desperate sellers and unsuspecting buyers. Dealer time bomb. Dealers do not truly own the rows of shiny RVs you see lined up under the lights. They rent them day by day through floor plan financing. Each unit on the lot is tied to a credit line, and the meter never stops running. A mid-sized dealer with 100 units might face thousands of dollars every single week in carrying costs. When demand was strong and units sold quickly, the model worked. But as values slide and customers vanish, those same costs become a time bomb. Every unsold RV becomes more expensive to hold, and interest compounds the pain. brain. The math is merciless. A motorhome that lingers for 90 days can bleed away thousands in interest and fees, turning any eventual sale into a loss. Dealers know they must cut prices or liquidate entirely just to survive. The system is designed for fast turnover, and when the market slows, the entire model cracks. But they are not the only ones stuck. The factories overshot too. Manufacturers overshoot. When production roars back too hard, the resale market pays the bill. During the pandemic years, factories throttled down, but when restrictions eased, they slammed the accelerator. Manufacturers wanted to make up for lost revenue, pushing out units at record pace. The problem was simple. The demand that looked permanent was only temporary. Families who bought once-in-a-lifetime RVs were no longer in the market, yet plants kept churning. Now lots across the country are stuffed. New RVs crowd dealer yards, and unsold models stack up against falling consumer interest. To keep lines running, manufacturers offered discounts and incentives that unintentionally punished existing owners by lowering comparable values. Analysts have already warned of guidance cuts, and supply has far outstripped demand. Dealers are left holding products that depreciate the moment they roll off the line, and once those oversupplied units spill into wholesale auctions, there is no hiding what they are really worth. Auction Truth Serum. Auction lanes do not lie. They are the purest signal of what a vehicle is truly worth. When repossessed units, lease returns, and dealer liquidations converge in one place, reality sets in. Bidders are cautious, lenders are strict, and reserve prices collapse. Every time a motorhome sells for less than expected at auction, it resets the benchmark for thousands of others just like it. In the last cycle, dealers could ignore auction numbers and hold out for retail buyers. Not anymore. Wholesale lanes are flooded, and transparency is unforgiving. Buyers with cash dictate terms, and sellers must take whatever the gavel brings. Dealers who resist the new reality risk carrying losses for months, watching their floor plan costs mount. Each auction becomes a pressure valve, releasing inventory but deflating values across the entire market. And that forces a brutal choice: adapt or close the doors. The only dealers who survive are the ones who change their playbook. Dealer survival playbook? The smartest stores are shrinking to win. Instead of chasing volume, they are trimming inventory, shifting toward towables and smaller units, and relying less on high-margin motorhomes that sit too long. Some offer cash incentives to accelerate turnover, even if it means thin margins. Others focus on service departments and parts sales to keep revenue flowing while sales slow. The goal is survival, not record profits. A few chains are experimenting with creative consignment programs, allowing private sellers to place units on lots without the dealer taking ownership risk. Others are pivoting toward rental operations to generate cash flow from idle stock. Dealers willing to cut fast and move inventory quickly may scrape through the downturn. Those who cling to bloated lots and outdated pricing models will face the same fate as the units themselves, depreciating until they vanish. But even the best survival strategy cannot outrun geography or fuel prices, and that is where the story heads next. Segment Bloodbath. Motorhomes bleed first. To wobbles, bend. The pain of collapsing values is not spread evenly across the recreational vehicle landscape. At the top of the pyramid sit Class A luxury coaches, enormous rigs packed with technology, luxury interiors, and sticker prices that rival houses. These were once the trophies of the boom, selling out faster than factories could build them. But when interest rates climb and gas prices remain stubbornly high, these heavy machines transform from dream purchases into liabilities. Owners desperate to unload them are finding that buyers are rare and discounts brutal. Towables, trailers, and fifth wheels fare somewhat better. They are cheaper to buy, easier to store, and can be hauled by vehicles families already own. Values are slipping, but the drop is not as catastrophic. Compact trailers and pop-ups may even retain some appeal as budget-conscious families downshift from luxury options. The message is clear: the higher the initial price, the harder the fall. And where you live will decide how fast the crash hits you. Geographic shockwaves. Urban America collapses first, rural America gets hit later, but harder. In dense metro areas, RV lots sit shoulder to shoulder, creating fierce competition as inventory piles up. Consumers in cities have alternatives: ride-sharing, public transit, or simply postponing discretionary purchases. So dealers slash prices early to spark movement. Already, reports from major markets show discounts stacking month after month, a race to the bottom where every dealer fights for survival. In small towns and rural counties, the crash arrives with a lag. At first, buyers keep showing up because cars and trucks remain essential, and RV culture is deeply rooted. But when job markets wobble and credit tightens, rural economies buckle harder. There are fewer buyers to absorb the glut, fewer service shops to keep units running, and fewer lenders willing to extend credit. What looked like resilience becomes vulnerability. Still, whether you are in a city or the countryside, your access to the market will depend on one powerful gatekeeper: the lender. Credit gatekeepers. In a buyer's market, lenders still pick the buyers. Falling prices may suggest opportunity, but banks are the filter. For households with pristine credit, approval comes with better terms and lower rates, opening the door to real bargains. For families with weaker credit histories, the opposite holds true. Higher down payments, double-digit interest, or outright denial. The same market that offers a chance at discounts locks out those most in need of them. The divide grows wider with every month. Prime borrowers with scores above 700 see dealers practically begging them to sign, offering incentives to move stock. Subprime borrowers below 650 face rejections or offers so punishing they cannot possibly accept. The wealth gap expands not because opportunity is missing, but because it is reserved for the financially strong. So who really wins when the market is rigged by credit? The answer lies with the people who have the patience to play the long game. The buyer archetypes. 3 groups will win big, and it is not who you think. The first are cash buyers. Without loans or trade-ins, they have unmatched leverage, walking into lots ready to close deals immediately. Dealers drowning in inventory treat them like saviors. The second are patient planners. These buyers hold back, watching values sink, and pounce only when the market hits bottom. Their discipline turns collapsing prices into personal windfalls. The third group are contrarians. While the herd chases the most popular models, these buyers scoop up the overlooked sedans, smaller trailers, less glamorous brands at fire sale prices. Each archetype uses a different weapon: cash, patience, or counterculture taste, but all benefit from the chaos. The common thread is awareness, understanding that markets do not just fall, they transfer wealth from the unprepared to the prepared. And while individuals win or lose in the shuffle, the shockwaves are only beginning, because the ripple effects of this collapse stretch far beyond RV lots. Local fallout? A closed RV dealer dents more than just sales. It dents towns. When a dealership shutters, it takes with it dozens of jobs, from sales staff and technicians to clerks and janitors. Service bays go dark, leaving owners scrambling to find qualified mechanics for complex systems like slide-outs and generators. Local suppliers who provided everything from upholstery to cleaning services lose steady contracts. The municipal government loses tax revenue that once helped pave roads and fund schools. In many small towns, the RV store is not just another business. It is a hub of community activity and a pillar of the local economy. The collapse radiates outward. Restaurants that counted on dealership traffic see fewer customers, fuel stations pump fewer gallons, and campgrounds lose long-term guests tied to sales promotions. A dealer's failure creates a domino chain that touches every corner of the town, and as the local pain spreads, the consequences do not stop there. They climb upward, from Main Street to boardrooms. Boardroom versus workers. Wall Street hates inventory. Main Street hates layoffs. The crash forces both into conflict. Publicly traded manufacturers cannot disguise the reality of bloated lots and canceled orders. Guidance gets slashed, quarterly earnings fall, and stock prices swing wildly. Executives scramble to reassure investors with promises of cost-cutting, but those cuts often land hardest on the workers who assemble, design, and transport the vehicles. At the supplier level, the pain is even sharper. Companies that provide components like appliances, batteries, and chassis frames suddenly see purchase orders dry up. Temporary layoffs become permanent closures, and communities that depend on factory work face rising unemployment. The divide is brutal. Investors demand leaner operations while workers face shrinking paychecks and vanishing benefits. Each headline about guidance revisions conceals the human reality of families bracing for financial strain. And for the consumers who still dream of owning an RV, the next 12 months could rewrite the price book entirely. The buyer's clock. Miss the window, and you will pay for 5 extra years. Timing the RV market is not a guessing game. It is a strategy built on signals. When auction clearance rates tick upward, when dealer incentives multiply, and when lots overflow with discounted units, the bottom is approaching. Industry veterans suggest that values will keep sliding until excess inventory clears, a process measured not in weeks, but in seasons. Buyers who rush in too early may catch a falling knife, locking into payments just before another round of markdowns. The sweet spot often arrives when desperation peaks. Dealers eager to shed stock slash prices dramatically, while lenders still have enough confidence to approve reasonable loans. Miss that narrow window, and the rebound begins. Inventory stabilizes, incentives dry up, and bargains vanish. Smart buyers mark calendars, track auctions, and watch fuel prices, knowing those cues reveal the market's turning point. But if you already own an RV, timing is not about opportunity, it is about survival. You've stayed with me this far, which means you know the stakes. 3 million RVs are about to rewrite the market, and missing the next update could cost you everything. Subscribe right now and turn on notifications, because the moment this storm shifts, you'll want to be the first to know. The owner's trap. Waiting for yesterday's price will cost you today's equity. Many current RV owners cling to the hope that values will rebound, but every month of delay erodes their position. Negative equity traps thousands, forcing them to either roll debt into new loans or accept crushing losses at trade-in. The smart move is to act decisively. Sellers can gather maintenance records, invest in pre-sale inspections, and price aggressively to attract cash buyers before the wave crests further. For those deeply underwater, voluntary surrender or refinancing may be the only escape routes, harsh as they sound. What cannot be ignored is the speed of the collapse. Listings that linger will simply depreciate in real time. Owners must choose, cut losses now or risk deeper wounds later, because once the 3 million wave crests, the only question left is stark and personal. Were you ready or were you roadkill? The used RV apocalypse is no longer a warning. It's here, unfolding faster than anyone imagined. 3 million rigs flooding the market will decide who loses everything and who seizes opportunity. You've seen the signs, the traps, and the timing. Now it's your move. Protect your wallet, protect your future. Drop a comment with your take, hit like if you learned something new, and share this video to wake up someone else before it's too late. And most important, subscribe right now, because the next wave is already building, and you'll want the truth before it hits your driveway.